Okay, so here we go. So we started out kind of boring with quality management. There was a lot of boring sections this semester. So what about this one? You know, they start out with quality, and they define quality as if we need them to do that. But, you know, they like to be complete, I guess. And they do make the point that what we're talking about as far as quality goes here is not like a high quality item necessarily, like a Lamborghini or something is a higher quality thing than, you know, I don't know, whatever else. Is it doing what it's supposed to do? That's how they're defining quality. Is the company achieving what they're trying to accomplish? Now, total quality management, that's a good term to be familiar with, for sure. It's one of those terms that the name of it tells you what it is, right? So it's not hard. It's not something you might even need to make a note of, I guess, you know. A lot of times the term itself defines the term, right? Total quality management. You know, maybe to put it a different way than the book did, it is a continuous pursuit of quality, all encompassing, you know, in every aspect of the organization. Total quality, and you're managing it, right? But what is important about this section, and this is where your CPA question will come from, is this right here. That's the meat. That's the important part. All this cost of quality stuff. Klein, Becker, Wiley, they all emphasize this topic right here, or this portion of the topic. So this is where it's kind of at right here. That's your takeaway. So pretty logical. I mean, prevention, we know what that is. We know what it is when we see it. Most of your test questions are going to be, this is an example of which of the four, right? So prevention, you know, it's activities we're designing to help us do the job right the first time. We're trying to prevent problems from happening, right? We are thinking training. We're thinking engineering, redesigning things, that kind of thing. They've got a whole bunch more listed there. Prevention and appraisal. I don't think our book does mention this. No, maybe it doesn't. Doesn't matter. Those two together are often referred to, and you might take this down, conformance costs. I say you might take it down. I'll put it on your notes for you. How about that? Go. Add that for you. It's a good thing to note. It does show up in the other study guides. So I'd hate for you to have a question that gives you this list of costs and says, what's your total of conformance costs, and you don't know what it is. So that's those two, you know, the cost of conforming. Non-conformance costs is what the other two are. All right. So I feel like it's worth noting. So appraisal activities, you know, really preventing things, we're looking for things, right? You think appraisal, think inspection. You know, look at all the examples they gave. Inspecting incoming materials, inspecting in-process goods, inspecting the final product. You know, any cost having to do with the inspection activities, such as depreciation on test equipment, maintenance of that equipment, utilities in the inspection area. So appraisal, think inspection. Not hard to remember, right? So there you go with that. So internal failure costs. So now you've got a problem. Something's happened, but you caught it early enough. that it didn't go out to a customer. Yeah. So yeah, there was a problem, right? But we caught it before it went out. It's bad if the worst case scenario, it goes out to a customer. That's an external failure cost. Here, we caught it. Examples are scrap, and it's screwed up, let's sell it off and get a little money out of it. Rework, we're reworking it. Re-inspecting the rework products would be an internal failure cost. Any downtime because of some kind of screw up that happened, cost to dispose of messed up stuff, analyzing what caused the problem, that kind of thing, right? And then the bad thing is external failure costs. It got to the customer. There could be litigation, there could be warranties, returns, lost sales because people are mad at you, that kind of thing. So easy content. You would love to get these questions on your CPA exam, right? So that's the good stuff. This other stuff, not as big a deal. Six Sigma, I would say odds are you'll not see that ever again on any exam. I think you've heard it enough in passing to where you don't really know exactly what it is, but you know enough of what it is. You can answer the really broad question they give you, right? But I wouldn't worry about Six Sigma. You got to play the odds. You can't remember and learn all of this. You're learning all that you think is important for the exam that you're going to have to take. But you probably won't forget Six Sigma quality. That's about all you really need to know about it, honestly, right? Total quality control is a term that comes up every now and then. Where that came from? The book says. Now, this is one of those things, the Ishikawa fishbone and the Pareto diagrams, that I blew right past thinking, well, that's kind of an oddball thing that we would probably never see. And I still think that. However, Becker covered it, Gleim covered it, and Wiley covered it. So it did show up in all three, which kind of tells me that the CPA blueprint probably somewhere specifically mentions those things maybe. Again, odds are you probably won't get anything on it. I have actually used the Ishikawa fishbone in a meeting where we're doing some things. So whoever decided we were going to do that, call it the Ishi Fishy. Yeah. I had never heard of it before that, but it was pretty cool. It was very useful, actually. It was pretty neat. I felt pretty smart being a part of it. But, it's just a really ultra organized way, which I love, to identify problems and the causes of the problems and carrying it farther. How can we handle it? How can we deal with it? Is it something we can fix, or is it something we're kind of stuck with? That kind of thing. And then the diagram, they do mention that, and all the other test the other test prep companies do mention those as well. But again, I don't know that you would see that on an exam. Let me say a lot of what I'm saying like that, all my opinion. I could be wrong. I'll be wrong about something. Y'all all be on your CPA exam. You'll be like, he said that wouldn't be on there. It's going to happen. Something's going to be on there. But when I say something like that, I'm saying odds are probably not. And if so, one question probably, right? And you got a 25% chance of getting it right. Maybe better, depending on how crappy the multiple choices are. So yeah, if I'm worrying with this section, I'm worrying with this, and that's about it. That is my opinion. Likely CPA questions are going to give you some example of this and ask you to identify, it's perfect. There's 4 different things, A, B, C, and D. It's an easy test question to write. So you probably have a good chance of seeing those because they're easy to write. People like to write easy things. It could be carrying it a little more in depth. They might give you a list of different costs with actual dollar figures on it and ask you to add up the total cost of prevention cost or the total cost of appraisal cost, or maybe even a little farther, the total non-conformance cost, or, you know, something like that. But there you go. Questions or comments on this section? I thought the multiple choice questions from our software, every now and then they'll throw something in there that doesn't really fit, but it's okay. Just deal with it and move along. I don't know why they chose this question for this section. We hadn't talked about all that yet. But this is more typical of what you would see for this topic. You know, in a quality control program, which of the following are categorized as internal failure costs? So you got 3, and you have to decide yes or no, yes or no, yes or no. So, you know, I'm thinking, all right, internal failure, something screwed up, but it didn't get to the customer. All right, something screwed up, I'm reworking it. So yes, something screwed up. I'm not responding to customer complaints because I caught it earlier, but I'm probably going to do some statistical quality control procedures, maybe, maybe not. That's very vague. That could be a prevention thing. That could be an appraisal thing. Oh, wait, this is internal failure. Never mind. Sorry. I was thinking it was appraisal. I think I was thinking of a different problem. So it's really just rework only. That's a typical type question. And this is a question that the author wrote. This is not an old CPA question here. You'll see a lot of those if you're going through. You'll be able to identify them easier and easier as you go through. So, you know, pretty straightforward. You know, whoever wrote the content wrote it, and they're like, I'm dealing with this, so they threw a question together. It's pretty much what happened. Which of the following methodologies would be most effective for a company that wants to reduce its rate of defective products? None of these have anything to do with any of it, right? So there you go. So not a super important section. Let's not worry so much about number 1 yet. We really haven't talked about this, but you got the answers. The questions are a lot more complex than number 3 here. Yeah, that is. Now, they're not all hard, though. I mean, there's some easy CPA questions for sure. And I guess that could very well be one, but not really. That's just a variable cost. Yeah, that one's pretty dumb. Yeah. It really is. Yeah, you're right. All right. Moving along, man. All right, this one won't take long to talk about at all. They go extremely way overboard in the content here. All right. What do you need to know? Balanced scorecard, that's a good thing to know about. It shows up in every managerial or cost textbook. It certainly shows up in all the prep material that the companies do. So know what that is if you don't already. You know, when you're thinking balanced scorecard, think multiple performance measures, hopefully all working together, you know, each kind of, you know, doing this should help this, which should help us do this, which in turn should help us do this, which in turn should help us do this, right? Goal congruence. So yeah, I mean, we need to know what that is for sure. And these perspectives, I don't know if I'd just memorize them, but it's worth kind of putting away, I guess, at least to the point where you can navigate through a problem. You know, all the texts do mention those, but you know, they go into all this how to create a balanced scorecard. Just cross all that out. That's not useful for us. Knowing what it is useful. Knowing these 4 perspectives is probably useful. All this stuff about delivery cycle time, manufacturing cycle time, manufacturing cycle efficiency, I wouldn't worry about that. Different books would probably call it different things. So it's not a thing you're going to have to memorize. But even so, look at the name of the thing, delivery cycle time. Well, think about what that could be. It's the time between, the time to deliver, right? It's in the title. Manufacturing cycle time, the time to manufacture. You don't have to put in all the thorough words that they do. You don't have to say it's the time between the order and the delivery. You kind of got that, right? So, yeah, read through it, but I don't think I would take a note of it to revisit as you're preparing for exams. I think you already will know it, right? Benchmarking, y'all know what that is from everyday life. So you can move along from that. It's important, but it's not something you need to take notes of, right? CPA questions from here would probably be something like identify some example of a performance measure. This is on there. Is that an example of financial? Customer, you could even say customer satisfaction here if you want a more thorough description. Is that a type, where does it fit? Which of the following balanced scorecard perspectives examines a company's success in targeted market segments? Obviously customer, right? Really logical stuff, right? So here's the questions they had. The one I just mentioned. Customer, right? If you had never read this chapter at all, you'd know this. Which of these measures would be useful in evaluating the performance of a manufacturing system? Throughput time. If you don't know what that is, sounds like something, doesn't it? So it's like, yeah, it sounds like a thing that we would probably use. You can reason through this. Total setup time over total production time. Seems like that could be useful. It's not something we necessarily specifically learned about, but that could be a useful thing. And that third one, number of rework units as a ratio to the number of units completed, sounds like a useful number too. So this is not things we're memorizing, it's things we're reasoning through. A lot of what we have to do on the CPA exam is going to be just taking what you know, logically going through it and figuring it out, right? There's no way to study for something like that question. Simple definition here. It's easy to do these when it's specifically related to, and that's the only term that they talked about. But there you go. Simple definition on this one too. Which of the following types of performance measures integrates? Yeah, but yeah, not a real heavy section here. Take a couple of notes of a couple of things and move along, right? But so those should have gone fairly quick. Then we get into kind of the fun stuff, right? To me, anyway. Maybe a little overwhelming. Things we've seen before for the most part. Things we may not have seen before and that kind of overwhelm us, but we're going to make that better here in a second. All right, what's important here? Return on investment? Absolutely. Make a note of that one, keep it handy. That's classic stuff right there. I don't think you'll forget it though. So here's the thing, you got return on this, return on that, return on the other. All right, the thing about return on ratios, it's always net income over whatever they're returning it on, right? Return on assets, net income over assets. Return on investments, essentially the same thing. I'll talk about that in a second. Return on equity, net income over equity. Return on whatever is net income over the whatever, right? So that's easy. You don't have to worry about the return on things. The turnover ratios, kind of the same way. We'll talk about those in a second. You can easily figure those out without having to memorize them. Now, what can make these a little bit annoying is every problem's a little different in the way they present the information. You just got to take what they give you and do the math with what they give you. For example, they may give you 1 year's worth of assets. You just got to divide by that 1 year that they give you. If they give you 2 years, you better be averaging them. You just kind of have to take it as it comes. They're not always going to be friendly with you. They'll give you different variations of information. You just got to do it with what they give you. So yeah, return on investment, very simple ratio. Net income from the income statement divided by either average total assets or total assets, whatever they give you, right? All this DuPont stuff, maybe not. You already know it, you know. Return on sales. Pretend like you've never seen that before. What do you think it is? Net income over sales, right? We just said return on is net income over whatever the return on is, right? Asset turnover, we're about to have to learn that anyway. So you kind of already know the DuPont thing without having to specifically say, okay, I'm learning the DuPont thing here. It's a neat thing. It's an important thing. You know, it's something we hit up on pretty early in the financial statement analysis course because it's so handy. You know, here's what kind of return you're getting. Is it coming from margin or is it coming from turnover, right? You know, with Walmart, you'd have lower margin, higher turnover. You know, some other company might be the opposite. So it is a good tool for sure. And
if you get the same ROI,
it's just expanding the ROI number. Yeah, yeah. It's picking its pieces a little bit, getting different components. You know, the profitability side of it and the efficiency side of it. More information. I want to highlight it because I feel like it's probably pretty important, but you kind of already know it anyway. Really, all you have to know is you're multiplying, right? And, you know, because you've got sales on the bottom here and sales on the top here, they cancel each other out. So it's really a DuPont ratio is taking whatever, you know, we got ROI here, net income over assets. It's just taking that ratio, splitting it up, and putting sales in each other, right? Net income over sales, sales over assets. That's all the DuPont measures are. DuPont anything is just taking whatever the ratio is and sticking sales on each side of it. So it's no problem. Residual income, very important. Very important. You've seen it before. It's real easy. We'll work through some of those here in a second, but you know, we've probably talked about it before in other classes, but ROI is fine. It's good to compare. You know, ratios are always good for comparing things, but ROI is kind of weak if you're analyzing what a manager did. You know, for example, if you are wanting your management to accept anything that'll give you a return of 20% or better, but that manager's sitting on a 25% ROI right now, they're going to be like, I don't want that. That's going to bring my number down. Meanwhile, the company's saying, I wish you would take that because that's going to bring our numbers up. So to keep that from happening, residual income just measures in absolute dollars. You know, anything providing a return over whatever management wants is giving them a better residual income number. So that's all it is. And we'll do some examples here in a second. Economic value added. All three of the texts do mention it. But my goodness. Yeah. You might get unlucky and get one question. Maybe remember that it's a variation of residual income, really, right? You're not doing net income minus your minimum desired return, but you're doing net operating profit after tax, which is a very complicated number to calculate. So they're not going to ask you to do that. They would give it to you. And then you're subtracting, again, that minimum number. So they mentioned price elasticity of demand. That's going to be covered way better in economics later on, so we'll save that for them. So really, this is just ROI and residual income is really what this boils down to. And they give us plenty, I think, to do. And it's really good to work through examples like this to get a feel for the different ways they'll present it to you. Every problem I'm putting up, by the way, is straight out of what you already done. I just put it on a Word document so I could write on it if I needed to. So here's what I do with test questions that are number crunchers. I always look at the last line first to see what they're wanting me to do. So I'm on an exam, I look at this, I glance down, and it says ROI. So now I know what I'm doing. I'll even think before I even read it. All right, what's return on investment? It's going to be something like some net income number, however they give it to me, divided by some asset number, whatever they give to me. They could present it some number of ways. You just have to deal with what they give you, right? So they give you sales. We don't want to stick that in the numerator. That's not net income. That's gross sales, right? They give you variable costs. They give you traceable fixed costs. All right. So ROI, we use that to evaluate how somebody performs. So they stick that traceable number on there instead of just all the fixed costs. They've kind of thrown out the fixed costs that this manager we're evaluating had no control over. That would be appropriate, right? Doesn't matter to us. That's the number we're going to do. And then they tell us the average invested capital. I don't feel like I'm going to use that. Oh, I mean, sorry. The interest rate I'm not going to use. Average invested capital, that is their version of that asset number that we're going to have to use. So see what I mean? They're not going to be real friendly sometimes and just say net income is this, the asset number you need is this. You kind of have to fish it out of what they give you. But there you go. You know enough to do it, right? So we got to compute net income here. That's no problem. Sales, 311, variable cost, 250. Their fixed cost number was 50. So our net income number that we need in that numerator is going to be 11. They give us the one asset number. We don't have to average anything out because they don't give us anything to average it with. That's the only possible thing we could use. Divide it by that. And we're good to go. Pretty simple, 27.5%. That's a really easy example. Yeah. And that could very well have been a CPA question. They're not all super complex. So don't think they always are. That's that would be a good example there. Another good lesson, don't always use it just because they gave it to you. You don't need that. In real life, you would say, oh, 27.5% is the return on here. That's way better than this 10% required return that they have, right? But that's not part of this problem. You don't need that. You don't need that at all. So they will often throw in junk you don't need. Questions, comments, anything? Okay. By the way, I'm going to hit the save button on this and post it when I'm done, so you'll have it if you need it or want it. Okay, so here's another one. I'm glancing here and I see, okay, residual income. So now I know by heart. You should know by heart that residual income is net income minus, right? Some percent number that they give you, they could call it a number of things. If they give it to you at all, times some investment number. That's our formula. So we should know that. Can y'all see that okay? It's hard to write on this thing very neatly. So that's what I do on a real test question before I've even read the thing. Then you read it, and then you're like, whoa, look at the crazy way they're giving me this information. But at least now, before you've read that and gotten overwhelmed with it, you know what you're looking for, right? So we'll take what they give us and see if we can figure it out. This is a little tricky. They'll give us things that we're not quite ready for in this content sometimes. We haven't talked about what asset turnover is yet. So that's okay. We can use these to learn from as we go. So I'm going to have to say to myself, all right, think, what is asset turnover? Again, we haven't covered it yet as far as this class goes, but asset turnover is sales over investments.
Use assets,
Pardon?
different sources says sales over investments, sales over assets. Sales.
Yes, yeah. Any different problem can call that any number of things. Assets, investment. What's the other one you said?
Yeah, assets.
Asset or investment. Yeah, it's usually one or the other. It's just one of those. Take what they got and use it. So we know that whatever those numbers are, when you divide them, is 1.5 times. So we know that. Then they tell us that sales number, so we know that part of it, which means we know the rest of it, right? Like a little puzzle sometimes. So now we can real easily figure out how much that investment is. So that investment is $500,000. Slow down and write a little better here. All right, so we know this now. Now they tell us that return on sales is 8%. So now we got to think, all right, dang it, it'll wear us out. Return on sales. It's a return on, so we know that the numerator is going to be net income. And the denominator is going to be whatever they're telling us the return is on, sales. So they tell us up here that that's 8%. We just happen to know how much sales is because they tell us. So we'll figure out what net income is based on that. So net income then is $60,000. We'll make us work for this one. We're good to go now. We know net income. We know we know investments. We know required rate of return because that's the last thing they give us. They can call that so many different things. You see a percent that's not, something like return on sales or something. They might call it weighted average cost of capital. They might call it the imputed interest rate. They might call it the required rate of return. They might call it the appropriate discount rate. They can call it so many things. All right, we're ready. So net income is $60,000. Required rate is 12%. The investment that we need at least a 12% return on is $500,000. So what this company is saying is, hey, manager, here's $500,000 you need to earn a return on. We need 12% or better. In other words, we need $60,000 of income out of you. Well, that's exactly what they did. So that is a residual income of 0. Which you do all this and you get 0, and then you're like, oh, did I screw something up? Because that's an odd answer to get, honestly. They make you work for this one. So yeah, and it sounds bad, but the manager did meet what was required of him or her. So it's not a bad thing. They earned an exact 12% return, which they were requiring of them. So, all right, they worked us to death on this. That could very well be a CPA question. You just gotta take your time, think about what you know, find what's missing. Kind of fun. It's 3 problems in 1, right? Okay. So here they're giving us a pretty complex problem on something they really didn't cover in the text. But that's okay. We can use the problems to learn from. That's okay. That's part of the learning thing too. Weighted average cost of capital is an important concept, and we can really narrow it down. You know, you're multiplying lost the word I'm looking for. The cost. Sorry, it's been a long day. You're multiplying the cost by the weight. That's really all it is. So if you're asked to compute weighted average cost of capital, you know, it's a real simple idea. You're looking for the cost of debt, multiply the cost of debt by the weight. How much debt's in the, you know, what percent of your capital structure is debt. Then you're going to find the cost of equity, multiply that by whatever percent of equity is. They've made this a little more complex. I've never seen this before, but they throw preferred equity and common equity on us and give us percentages of each of those. So we got really 3 costs to multiply by 3 weights. But it's easy enough. So, you know, you don't have to freak out on something like this. So here's an important thing about cost of debt. And I think they're nice to us on this one there. No, they're not. Okay, that's a good. All right. All right. So the target capital structure of this company is 50% debt. There's our weight that we're going to multiply by. 10% preferred equity, we're going to multiply by that weight. 40% common equity, we're going to multiply by that weight. Now we just need to see the cost of each of those to multiply it by. We're halfway there. So the interest rate on debt is 6%. That's another way of saying, you know, you got to think is through, you know, you got debt costs you something. What does that cost? The interest you pay. So the cost of debt is 6% right now. The yield on preferred is 7%. That wording kind of throws me a little bit, but I know what they mean. So cost of preferred is 7%. What else could it be? Cost of common equity is 11.5%. So really the only hard thing about this, but it's an important thing, is you got to remember the cost of debt and interest rate is 6%, but you get a tax deduction for it. So you need to back out the tax savings from it. That's an important concept. That shows up in a number of places on a number of different things. So yeah, it's 6%. But once you get that 40% deduction, you're really only paying 60% of that 6%, right? That's a very important thing to be able to know how to do. Does that 60% make sense? You'll have to use that logic a lot in a lot of different places. So 40% tax rate means I'm saving 40%. It also means I'm still paying the 60% that remains, right? So my cost of debt is 60% of that 60%. So that's 3.6%. Cost of equity, cost of preferred. 7%. Cost of common, 11.5%. We got our costs. Now we just got to weight them. Weighted average cost of capital. Figure out the cost of each of those things, multiply them by the weights, add them up, and you're done. Cost of debt is 3.6%. That applies to half of our capital structure. So this is the cost. This is the weight. So 1.8%. 7% cost of preferred. That makes up 10% of our capital. So 0.7. And then 11.5% cost of common. That makes up the other 40%. Eyeball that real quick. Make sure it totals 100. It does. 4.6%. Sorry, it's hard to write on this thing. Add them up and you're done, 7.1. Sure.
You really give the 60%.
Where did I get the 60%? Okay, really important concept that you'll have to apply in a lot of places. It's 1 minus the tax rate. Right. So think about an amount let's say you made $100,000 dollars, right? Or let's say you, whatever, $1,000. If you got a 40% tax rate on that, you have to pay 40% of it. You get to keep 60% of it. Yeah. Now this is from the tax deduction and cost point of view. So here, your interest rate is 6%. 40% of that you really don't have to pay because you get it back in tax savings. You're responsible for the other 60% of it, right? So the cost of debt is 60% of that 6%. You get a deduction and tax savings on the other 40%.
That's really fun.
Yeah, kind of. But it shows up in a lot of accounting stuff. We'll have to do it in cost volume profit analysis when they say operating income before tax, we're good. Operating income after tax, we got to divide by 1 minus the tax rate. We do it a lot, so it's a good thing to get the hang of. Other questions? Okay. Residual income, I'm looking at the last line, so I'm thinking about my formula. This one is as easy as it gets, by the way. So I'm looking for net income. I'm looking to subtract by some percent times some investment number. Now I'm going to read the problem and find those things. They're throwing 2 divisions on us. They want to know what Division B's residual income is. So Division A means nothing to us here. Division B has operating income of $400. Okay, they've called it operating income here. Operating income and net income is kind of a different thing, but whatever. It's not wrong. All right, company's required rate of return is 10%. And the investment, they call it total assets, is $1,600. So this manager is being told, here's your $1,600. We need a 10% return or better on it, which means you need to at least make us $160. Anything more than that is great. They actually made $400 for them. So the residual income, the income they made over and above what was expected and required of them, bigger is better, is $240. Very simple. I'm reading the last sentence, so I know what I'm in for here. Which of the following is the company's cost of capital? Now I know that they're probably going to give me cost of debt, cost of equity, and some weights that I'm going to have to multiply and add. Now I'm finding the information. Company's trying to determine the cost of capital for a major expansion project. Survey, blah, blah, blah. Cost of debt's 8%. Now, what I know about cost of debt is I'm going to be on the lookout for a tax rate. They don't give us one, so now we're just going to use the 8% because we got no tax rate to deal with. So we'll just say, well, I'm assuming this is already after the tax rate has been dealt with. So that's what we have. Oh, this isn't as easy. This is the one where they give you the debt ratio. Okay. We'll come back to that. The company complies with this requirement and has determined that stock issuance would require a 10% return. So there's your cost of equity. They always word it a little different, but you can piece it out and figure out what they're telling you. Now we just need the weights. Now, they're calling this the debt ratio. You find 3 textbooks and they're all going to define debt ratio differently. Now, the explanation in the problem I felt like was wrong. I don't know if y'all looked at it or not, but they didn't explain it correctly, in my opinion. The way they explained it wouldn't work. The only way that we can answer this question is to interpret the debt ratio here as debt to total assets, total debt. Really total liabilities to total assets. In the problem solution, they said debt ratio is debt to equity. If it's debt to equity, we don't have the information we need. So they kind of screwed that up.
Wasn't there a whole separate ratio though, debt to equity ratio?
Yeah, it is. Which somebody might also call the debt ratio. You know, there's no set, you know, it's not like the current ratio where there's like the classic name for the classic ratio. You know, different books will call different things. You know, debt ratio, debt to assets ratio, debt to equity ratio. It could be either of those two. The debt ratio is really vague. They need to define that for us. But the only way we can answer this is to say it's really total liabilities over total assets. That's really the only way we can do it. So they're saying that is 40%. You know, total liabilities is 40% of your total assets, right? Which means equity is the other 60%. So cost of debt is going to have to be 8% times 40%. Cost of equity is going to have to be 10% times 60%. So that's going to have to be 9.2%.
But in an actual like CPA question, would they be clear? Or
Yes, they got to be. Yeah. I feel like an author wrote this one. Yes, that's a good point. She said the CPA question would be more clear. Definitely. CPA questions have gone through this rigorous testing and pre-testing, and people are finding stuff, you know, vague things like this and getting rid of it. So, and here's good advice for any CPA question. Take every word as literally as possible. You know, if they say it, that's exactly what they mean. Don't guess what they mean. Okay, I think that's it, isn't it? Yeah. All right. How are we doing? Questions on this? So 2 things really, right? ROI, residual income, and then they throw a third one on us that they really didn't talk about, weighted average cost of capital.
Will the weighted average cost of capital be on the exam?
It very well could be. Yeah, it could, because it kind of touches on some of this ratio analysis stuff, and also some of that financial management stuff, valuation stuff that we have to do. So yeah, it's an important concept.
So that more than EVA?
Definitely. Oh yeah, definitely. Cost times the weight, add them up.
That's tax thing.
And the tax thing for sure. Yeah, that's the thing. Oftentimes a question might be just what is their cost of debt? So they just test you on, do you know how to apply that tax thing? That's a real common question that I've seen. Other questions? Okay. So we'll add to our notes here. Cost of capital. All right. Okay. Overwhelming section here. But it doesn't have to be. So all of these ratios, so many comments from so many people. What do I do with this? Do I have to memorize all these? You shouldn't have to. You should be able to, it should click in your head what you're dealing with. We've already covered the return ons, right? Look at return on equity, return on anything, net income over whatever it is, right? We should be good there. Gross profit's a thing we should already know. Profit margin, we should know that. Contribution margin, we definitely know that, especially after the break-even chapter. So really, all this is kind of walking around knowledge anyway. These turnovers, they're important for sure. So notice how similar they each are. The turnover is going to be whatever the turnover is going to be in the denominator. Look, receivables turnover, receivables in the denominator. Inventory turnover, inventory in the denominator. Fixed asset turnover, fixed asset in the denominator, right? So you're halfway there just from knowing what the name of the ratio is. So what do you stick at the top? You stick at the top wherever that thing ends up once it goes into the income statement. That's kind of the best way to remember that. You know, what does that match up best with on the income statement? Where do our receivables come from? They come from sales. So that matches up. Inventory ends up on the income statement as cost of goods sold once the inventory is sold. So it matches up with that. Fixed assets is a little more vague, but the reasoning is fixed assets are in place to create more sales. So it matches up best with that. This chapter doesn't consider accounts payable turnover, but that's also a thing. So payables on the bottom. What about on the top? Hard to know. It is also cost of goods sold. The reasoning is in a company that sells a product, most of your payables deal with either the purchase or manufacture of your inventory. So it ends up, yeah, that's not as popular of a ratio. So I wouldn't.
That's one of the things.
Okay, so the rule is, for the most part, unless you're really diving deep, which we aren't, if you've got an income statement number in a ratio matched up with a balance sheet number, you want those to be similar to each other. That income statement number is a year's worth of sales. You want your balance sheet number to be as close to a year's worth of balance sheet numbers as you can. So you take beginning and end, average them. So that's pretty easy to remember. The even easier is let the problem lead you in the right direction. If they give you beginning and ending of that, you're probably going to use it. If they don't, you can't. So, yeah. So, yeah. Those are important and easy to remember. Those days numbers could show up. They always go such a roundabout way presenting that formula. So I stuck the easier one up there. Take your turnover number, take 365 and divide by it. That converts it into days, which is so much easier to interpret, by the way. You know, how long does it take to sell out my inventory? You know, that's 30 days is an easier number to interpret than 2.5 times, right? So the days thing is good. So that would be worth noting. So the turnovers should be easy to kind of grasp once you kind of get it in your head what they are. Current ratio, you better already know that. That's a classic. Current assets over current liabilities. Quick ratio, hey, the book really screwed that up. That is not a good way to measure that. And it will not help you with the test question. So current assets minus inventory, that's a shortcut that is not a good shortcut. Better is take those three things. Cash, your most liquid assets, top of the balance sheet. Cash, short-term investments, accounts receivable. That's all that's in there. Ignore the book's definition. I'm mad at them for that. Don't do that. Because you do that, you've also got prepaid assets in your numerator, and those aren't. Yeah. No. The others are, the name of the ratio tells you what it is: debt to assets, debt to assets, debt to equity, debt to equity. Now, if they're vague and they call it the debt ratio, we've already said, who knows? We could interpret that a number of ways. So they're not going to give you a bunch of numbers and say, what's the debt ratio? Unless there's only one possible thing you could do with it, right? We're getting a little out there with times interest earned, but an easier way to remember it that you'll never forget. EBIT over I. Earnings before interest and tax divided by interest expense. EBIT over I. Such an easy, nice, flowy way to remember it. Just don't forget what the I is. And I did have some trouble with people in the past interpreting it as earnings before income tax. No, it's earnings before interest and tax divided by interest expense. And it's just a measure of, you've got these interest expense payments you're responsible for. How comfortable are you covering those with your earnings? Higher is better. That one's a little more specific. It'd be one of those oddball chances that you would get a question on that one. But you won't forget what it is, EBIT over I. And then all these others, I don't know, probably, price earnings ratio kind of tells you what it is in the name also. If you think about it, it may not click immediately, but price, market price of the stock per share divided by earnings per share. Market to book ratio, that tells you exactly what it is too. I wouldn't even worry about market to book ratio, but if you take a note of any of this, price earnings ratio maybe, it's a common measure, but test question, probably not. But these could show up. Would show up, and these will probably definitely show up too, and any of these too. So I probably shouldn't just highlight without highlighting some. All this is important, but those are kind of important elsewhere beyond this chapter. Specific to this chapter, we just covered those. They're obviously important. That looks like I'm dividing. I'm not. Those are kind of used interchangeably sometimes. Return on investment, return on assets. So that narrows it down for us, right? Don't go into your test not knowing these liquidity ratios and these turnover ratios, for sure. And I stuck this on here. Sometimes they're a little complex with their questions. What would be the effect of adopting just in time on inventory turnover and inventory percentage? Don't start writing down, is that one of our questions? Okay, we'll get there. That was earlier. That was way back up here. Now we're ready for that. Okay. You get a question like this, I wouldn't think about it in terms of numbers. I would just think about it logically, right? Just in time. Y'all know what that is. You know, you're cutting the inventory levels way down. So what would that do to your inventory turnover? And you do have to know what the inventory turnover is. You're dividing by inventory. Smaller inventory means a bigger turnover, right? And less inventory, you'd be selling it out more and more and more, right? So your inventory turnover goes up. And inventory percentage is just what percentage of your overall assets is inventory. By its very nature, just in time is going to decrease that. So you just kind of think your way through this one pretty quickly. I don't know why they stuck it in section 1 or whatever. Puzzle type problems in this. You'll see those a lot. So again, I always look at the last sentence first just to get an idea where I'm headed with this. They're wanting to know inventory turnover. So I'm going to go ahead and jot down what I know that formula to be. I didn't memorize it. I kind of learned, well, I kind of memorized it, but I memorized more broadly what the turnovers are. So I know inventory turnover, so I'm going to have average inventory on the bottom. And then I'm going to think, where does that end up on the income statement? I'm going to stick that on the top. That ends up as cost of goods sold. Now I just got to find the numbers. So now I'll read the problem. To measure inventory, blah, 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 blah. Here's some numbers. Annual sales they give us last year and this year. Gross profit percent they give us last year and this year. And then they give us all these, basically follow the directions to answer this problem, right? Beginning finished goods inventory this year was 15% of last year's sales. Ending was 22% of this year's sales. So they just kind of make you piece it all out, right? So we got to figure out the inventory number. We got to figure out the cost of goods sold number. They're not as nice to us as they could be, but it's really not that big a deal. So cost of goods sold. How are we going to figure it out? Well, they give us sales and they give us the gross profit percent. So we kind of got to know what they mean by gross profit percent. Gross profit, usually when they're vague, I don't say vague, but something percent is usually a percent of sales. Yeah. So gross profit percent is going to be gross profit as a percent of sales. So we can think, okay, well, sales is contributing 40 cents to gross profit, which means the other 60% is going to be cost of goods sold, right? So cost of goods sold is going to be $2,525,000 times 60%. The other 60%. 40% keeps going, 60% swallowed up at cost, right? So cost of goods sold is $1,515,000. So there's our top number. Inventory, again, it's just kind of like you did in elementary school, follow the directions. So beginning inventory, we need average, right? Because we're matching the income statement number with a balance sheet number, and they give us the information to get the average. So we got to do it that way. Beginning finished goods. They tell us that beginning finished goods this year is 15% of last year's sales. 15% of last year's sales. That is $318,750. You never know when I'm going to stick a dollar sign on a number. I'm very inconsistent about that. Sometimes I do, sometimes I don't. Ending finished goods they tell us is 22% of this year's sales. So 555, 500. All right, average those up. Average is 437, 125. All right, plug it, divide, done. So 515 over 437, 125. And that is 3.47 times. So there you go. Easy enough, just a lot of work. All right, number 2 here. What is sales for the year? So they're making us find sales based on whatever else they're throwing at us here, right? So they tell us operating income before interest and tax. They tell us what plant assets is on the balance sheet for beginning and ending. They tell us that ROI is 25% and investment turnover is 2.5%. What is sales for the year? So they give us a bunch of stuff we may or may not need, but as I'm step by stepping my way through this, here's what I did. I said, all right, here's what I know. They give us an ROI number. We didn't end up needing this at all, or not the way I did it anyway. The solution set it up to where you used it. So I'm just working my thought process here. So we have that information. And then they tell us investment turnover, which we may not have heard that word yet, but we can reason through it based on what we know on turnovers, right? We can say, okay, it's turnover, so whatever we're turning over belongs in the bottom. Probably average. And it's really another way of saying the asset turnover, right? So these investments don't really create sales, but in the typical way we think of investing in stuff, but here they're really saying investment in assets that we're using in the business to create sales. So there's the formulas involved with the information they're giving us, right? So we didn't really need this the way I did it. The answer key kind of uses that to take us through it, but the way they used it, the crazy formula they used, is not really a good way of doing it, in my opinion. This was pretty easy this way. So we know that this number is 2.5 times, right? Sales is what we're looking for. So hopefully we have average investment. We do. They just flat out give it to us. So this becomes really easy, actually. So there's your beginning and ending investment numbers right there. So the average of those is 20 million. So what divided by 20 million gives you 2.5. 50 million, right? So this one was actually really easy.
That's a lot easier.
Yeah, they did something crazy. You can't always go by the way they do it. Develop your own way and stick with that. I did it and then looked at the answers and how they did it, and I was like, what in the world did they do?
Yeah, so one way after looking at the answer, how they did it, more confused than when I would do the questions. So.
Yeah, so when that happens, just trust yourself and move along. Yeah, for sure. Number 3, this is just definition really. how is contribution margin different from gross margin? So that requires you to know what those two things are, right? You definitely better know those. Contribution margin is sales minus variable costs. Gross margin is sales minus cost of goods sold. Very important definitions. Gross margin, gross profit are the same thing. Those are used interchangeably. So how is it different? Really, it's just like, which of these definitions is correct? The first one says contribution margin equals sales minus cost of goods sold. So that was wrong. The second one says contribution margin equals sales minus variable cost. Okay, we're good with that. All right. Gross margin equals sales less cost of goods sold. That's exactly what those two things are. So there you go. Nice and easy. They're not all hard. 4. This one didn't make sense to me. Tell me if y'all agree with me on this. The way that, do y'all remember this one? Did y'all answer it opposite from, do y'all remember? Y'all didn't. Maybe I'm reading it wrong. All right, let me tell you what I'm thinking on this. It says they're analyzing financial statements for this reason. Quick ratio is better than the industry average. Which of the following factors should we consider as a limitation of using the ratio? Now, the way I read that is we're using the quick ratio. What's the limitation of that? The limitation to me is inventory is not considered. So I thought it was not a limitation, not a limitation, yes, a limitation. Now, how did y'all interpret that? Because my mind's not clicking with this one.
I don't know how to interpret that. Quick ratio.
You just knew that. So.
But again, I never really knew what marketable securities was either. So I kind of like that question.
You should know that. That term shows up a lot. So short-term investments, marketable securities, same thing.
Okay.
Yep, that's a good thing to know. I answered it right because I knew that these two needed to be the same thing, and this one was the oddball. So I did answer this, but the way I was interpreting that was it needed to be no, no, yes.
I guess when I said evaluating creditworthiness, I was thinking like there was only two that would put limit on their creditworthiness.
Okay. Yeah, I didn't read it that way. I see what you're saying. Well, you know, whatever. I got it right. I didn't get it. So I guess getting it right is the important thing. All right. I guess mine was like the way I would reword this, the way I was understanding it is they kind of were asking which of these does the quick ratio not capture. That's how I was kind of interpreting it. But I see what you're saying. All right. Huh?
It just takes a lot of thinking.
It does.
I'm sorry. I came out from Southern. Yeah.
All right. Moving along. This is the last one for this section. It's an ROI question here. So I'm going to think to myself, what am I looking for? I'm looking for net income over either investment or average investment, whichever they are giving me. Looks like we get average on this one. So, do what? Yeah, this one's extremely straightforward. You're right. So they give you like a 1 there, but it's not. That's a plus. So we're averaging those out. And there's your average investment. Operating assets at the end of the year, operating assets at the beginning of the year. I guess the biggest easy mistake to make here would be to slap sales down at the top without thinking. Be careful with that. But yeah, it's just net income is what we're wanting. Return on investment. So we gotta say, all right, sales is 1,150,000 minus all these expenses gives us our net income number, right? So 600,000 over 6 million. 10%. Pretty good, easy little question there. All right, there's so much more they could ask here. They didn't hit on current ratio at all. You know, types of questions I've seen before. Which of the, this happened. Would that increase current ratio? Would it decrease it? Would that increase or decrease inventory turnover? Which of the following would cause financial leverage to increase? So then you got to think, well, what is financial leverage? It's a word they throw around quite a bit. More debt means more leverage, right? So then you think, all right, what will this do to my debt? And then there you go. So they can get a lot more complex with this. So the more examples you can work, the better. You'll see things like, which of these things would increase current ratio and decrease profit? Which of these things would not change current ratio or something else? That's a real common type of question. I can't think of any exact ones to throw on you, but there's a lot of things they could do here. All right. Comments, questions, anything?
If you look in the test bank, there's like 38 questions for this section.
Yeah, I'm glad you mentioned that. Did y'all notice there is a test bank you can click on each time? Yeah, for sections like this, the number crunching sections, probably a good idea to work as many of those. For the goofball sections like balance scorecard or whatever, maybe not as important, but it never hurts to look at all of them. The more you can look at, the better. The more of those you can look at, the better you'll do on the CPA exam. I guarantee that.
So they just test bank for these different questions that could have been on what we took.
Yes. Yeah. We've got to keep classes going like this, but they got test bank for people who are really studying it up, which hopefully we are all doing. I'd hate for any of us to get out of this class and not go ahead and take the CPA exam section. Speaking of stinking sections that are horrible, this risk management, that's the most useless section of content I've ever seen in my life. There's nothing there. I originally had a note, there is nothing useful in this section, and then I went back and found a few things to throw in there, but now I regret doing that. There's nothing here at all. So, next. And the questions were crappy too. One of them was about insurance. I mean, hopefully we know what hedging is. That's kind of walking around knowledge, and they do talk about that kind of thing. But there's really nothing here much. So moving on to the next section. This is a real quick one too. Theory of constraints is something to be familiar with. When I taught advanced costs back in the day, I had a pretty interesting little book that we would read called The Goal. Have y'all ever read that? Heard of it? It is a novel with a story and a plot and characters and stuff like that. But it is about a factory where the factory's having problems and they figure out a way to deal with it. And it's all having to do with bottlenecks and theory of constraints and throughput and how to deal with it. It's pretty interesting if you like reading stuff. The Goal. But theory of constraints, this is the idea of a bottleneck in the process, something that is slowing the entire process down. So you got to free up that capacity to help the overall process. Pretty logical, right? So theory of constraints is going to kind of deal with strategies of how are we going to maximize income when we have a bottleneck. And this kind of gets a little bit into that whole scarce resource problems that we would do in cost accounting in the make or buy chapter and the special order decision chapter. We'll hit that later in this stuff too. But the answer is maximize the contribution margin per unit of the constrained resource. We'll work problems dealing with that later on in the semester. But that's a good thing to know. Theory of constraints is a good term. But the really most important thing about this is that right there. When you have a constraint, what do you do while that constraint is there? You want to maximize not the sales, not, just the volume and the sales or whatever, but what kind of contribution margin, the highest contribution margin per whatever is limited. If time on a machine is limited and you're trying to decide, well, should I send product A through that machine or product B through that machine? You're going to look at, well, what does product A contribute and how much time does it need on that machine? And you're going to see what's the best use of that resource compared to product B. We'll work problems on that later, but the term is here. Lean whatever is an important concept too. Lean, think doing more and more with less and less. That's lean in a nutshell. Think about, lean's a cool concept. You apply lean ideas to some of these ratios we just looked at, and those concepts will make those ratios look better. Increasing sales, decreasing inventory, decreasing receivables, all that is good stuff. More and more with less and less. The less inventory I have to keep on hand, the less costly it is. I don't have to insure stuff. I don't have to store it. I don't have to let it ruin or become obsolete. More and more with less and less is lean. Their fancy definition here is strives for perfection in quality and removes layers of waste. It's just more and more with less and less. That's a better, easier one to remember. Trying to create precise consumer value, they say, with less effort, less space, less capital, less time, more and more with less and less. Pardon? Yeah. Improving, cutting all the stuff out that doesn't need to be there, and improving, being more efficient for sure. Yeah, absolutely. Okay, I don't remember if these problems were any good or not. This number 5 is just a good little problem for the concept, right? About the whole theory of constraints idea we just talked about for short-run profit maximization. When there's some kind of constraint, what should they do? They should go for whatever contributes the more per hour of capacity, which is the limitation they have, right? These other questions were kind of junk, so I would not worry about any of these at all. Junky questions. Those are. Yeah, it's just junk questions. They're not all good, so I wouldn't worry about any of those. Let's just move along. This isn't really a hot spot of stuff. That's it for this little subsection, right? Save button on that. Now we get into cost accounting. That's our wheelhouse, right? We know what we're doing in cost accounting. Should.
So those notes be.
Yeah, I'll post those up. They're already there, but not with my highlights that I've been doing. So I'll stick them back up there, and the problems too. So. All right, thing about cost accounting, we've seen it at least twice before in undergrad, managerial accounting, principles 2, whatever you call it, and cost accounting. The frustrating thing, I guess, is there's so much that could be asked, and you gotta figure out how to approach it. You know, it's like there's a lot of content here, and we really just kind of have to scratch the surface a bit. Now, all this stuff here is obviously really important. You know, early on in Principles 2, we learned this. So just kind of a reminder, you know, things you definitely need to know to get you through. What is a product cost? We're talking a manufacturing firm here, right? Product cost is direct material, direct labor, and overhead. You got to know that. If you don't know that, you're in trouble. Got to know it. So, what do we mean by product cost? We mean something that's going to be on the balance sheet till we sell it. It's inventory, right? It is all the cost of getting that unit manufactured, ready to sell, right? Once we sell it, then it's an expense on the income statement. Period costs, though, those don't hit the balance sheet ever. Those are not inventory items. Those are things we're incurring outside of manufacturing whatever the product is. So we had 3 examples of what the product cost is: material, labor, and overhead. Period costs are going to be things we do after we manufacture it, like selling expenses, selling the product that's already manufactured. So that couldn't be a product cost. And then just kind of things that are off to the side, you know, administrative costs like CEO salary and corporate headquarters depreciation and can't think. Well, those are some examples. Anything to do with corporate headquarters would be, you know, that kind of thing. So those are just, you know, kind of early on Principles 2 stuff that you definitely need to revisit if you don't remember. Direct material, we should know what that is, of course. You know, you're manufacturing something. These are the materials that can be easily identified with the finished product. You see a car, you know the materials that are direct to that are 4 wheels, 4 tires, a steering wheel, seats, leather on the seats, that kind of thing. You know, there are materials that are not directly identifiable with something like spray, stuff you spray on, right? You know, lubricants and mess like that, and little staples and, you know, thread and stuff like that. You don't want to take the time to directly identify that with a product. It's not worth your while. That type of thing would be overhead, right? Another part of your product cost is direct labor. That's the cost of what we pay the people who are working and directly associated with manufacturing, putting together whatever the product is. People on the assembly line, people putting things together, people who are hands-on, right? Instead of people who are working in the factory, yes, but directly working on the product, no. Like the janitorial staff, like the supervisors, the security guard and stuff like that. Yes, that's part of making the manufacturing plant operate, so therefore it's part of the product cost. But you can't look at the car and say, hey, I see where the supervisor supervised that one day, right? But you can say, I see where they put the wheel on. That kind of thing. So that's also part of overhead. And also, in addition to that, Everything else is part of overhead. Taxes, rent, utilities, stuff like that. Depreciation on the machinery. A lot of other examples, but I'm having trouble thinking of examples today, so we'll leave it at that. So if you don't know that already, maybe revisit a principles text. A good definition that often shows up in problems is prime cost. It is simply the direct cost. So sometimes they'll throw that in as a piece of a larger problem a lot of times. They'll have all this there and that and the other, and ultimately they're like, hey, how much is the prime cost? So you have to find all the stuff and add it together. Conversion cost is another term that you'll definitely be familiar with when we do process costing. But by definition, it is labor and overhead. It's the cost of converting those materials to finished good. Good definition to know. Another definition to know, this is called manufacturing cost is the name of this chapter, but it's really just a bunch of terms. Value-added costs, that's another example of the term tells you what it is. It is a cost that adds value. You might be asked to identify examples of that, but sometimes there's examples that could be either, so they won't put that on you. Costs that enhance the value of the product in the eyes of the consumer. Things that if you took it away, they'd be mad at you. If you took the steering wheel out of the car, that's a bad deal. Steering wheel's value added, right? So pretty easy to identify what the value added costs are. We need those. We got to keep them. Non-value added costs, we want to cut those out as much as we can. Costs that can be eliminated without deteriorating the quality of the product. Setup time of the machines, that would be a non-value added cost. They're not going to be mad at you if you change around what you're doing with your setup times, right? So things that we could mess around with and eliminate without screwing up the product, that's a non-value added cost. Committed costs versus discretionary costs. Committed costs you're kind of stuck with. Discretionary costs you could choose to do away with. Advertising is a classic example of a discretionary cost. Just more terms. This is probably not quite as important, but it's pretty easy to know what it is. Let's see what they put on us as far as the questions go here. I felt like they took it pretty easy on us, honestly. This doesn't belong in this section at all. This is a make or buy question that belongs in a completely different section. So skip it for now. That's a little beyond us. Yeah. We'll be ready for that later, but this is not for us yet. Okay? So hold that thought. I mean, I can run through it real quick if you like, if it's fresh on your mind. Okay, we'll do it later in the semester. Remind me to come back to it when the time is right. We do have a section that covers that content. Okay, let me put something on you here that's going to be really useful. Let me go back to my notes on this one. I think I've already actually maybe got it in there somewhere. So this is way down in this section that they actually cover this. I put this together for us. This is something you need to just know by heart. All of this, it looks like a lot, but let me show you. You will have to use this, all right? Now, these three formulas capture the flow through the whole manufacturing process. And they can ask you questions on any of those. And it looks like a whole bunch of stuff, but really it's the same thing over and over. So definitely know this. You've got your 3 inventory accounts in a manufacturing company, right? Raw materials inventory, work in process inventory, and finished goods. So check this out. Beginning, I'm abbreviating, so there's no way I can do it without abbreviating. Raw materials inventory. The cost of the raw materials that you had on hand as you began the period, almost said semester. You will add to that throughout the year or the month or whatever by doing what? Purchasing more. As you reach the end of the month, if you subtract what you still have on hand, you're going to be left with what you don't have on hand anymore. In other words, what you usually used. It's an important formula. You can apply that to a lot of things. Beginning plus the additions minus what you got on hand at the end equals what you used. You can do the same thing with work in process. Beginning work in process. That's the cost of the materials, labor, and overhead that have been applied to units of goods that are not finished yet, right? We're working on them. Materials have been used, labor's been incurred, overhead's been applied. We just hadn't got a finished product yet. Our additions to work in process occur when we use materials, when we incur labor, and when we apply overhead. Those 3 things. So your beginning inventory plus all your additions to that. Subtract what you have on hand at the end. And you're left with the cost of the goods that you did finish. Cost of goods manufactured. You will often get a problem that the question is, how much is the cost of goods manufactured? Usually they'll make you start here, work your way through. You got to get this. That carries up to here, and then you got to work down through both formulas to get it. Very common question. All right. Finished goods is our other inventory. You got beginning. Your additions to that occur when you manufacture units, right? When they become finished. Cost of goods manufactured, I abbreviate. So that together is going to be the cost of goods you had available for sale. Subtract what you didn't sell, and you're left with what you did. Cost of goods sold. 3 formulas, they're all the same. They're just tweaked a little bit, right? Know that by heart. You know, you start your CPA exam that day, you should be able to scribble that on a page just like that. That will come up and that will help you. Now this one's easy. They only make us do this first formula. So I'm reading this. They're telling me that they want to know what our direct material purchases are. I already know that I'm going to need this formula, so I scribble it down. Beginning raw materials plus purchases minus ending raw materials equals raw materials used. During the month of March, they used $300,000 of. On March 31st, the end, their materials inventory was $50,000 more than beginning. I'm just going to have to make up a number. I'm going to say, well, beginning was 0. Ending was 50. Those are easy numbers. All right. Made it up. In case y'all look back at this and wonder where it came from. Made it up. So you could have put 50,000 and 100,000. You could have put 3,500,000, 3,550,000. Any number you make up. So 0 plus what? Minus 50 gives us 300,000. Have to be 350, wouldn't it? There's your answer. Really common question. It's not common for them to say this whole 50,000 more than beginning. I've never actually seen that before, but we can be ready for that type of thing. Usually they just give us your number and let's plug it in. Questions on that? I'll handle that.
That was pretty easy.
Yeah, it's pretty easy. More times than not, the question is going to ask for cost of goods manufactured and make you calculate this, bring it up, and calculate that. That's the most typical question here. All right. Very good. In a process cost system, we hadn't talked about that yet, but in any system, doesn't matter job or process, the application, applying overhead, not accumulating it, not incurring it, but applying it to the products. The application of overhead usually would be recorded as an increase in what? All right, so think it through. We're working on a product. As we work on it, materials are being put into that, and we record it into the work in process inventory as we use it, right? Labor, as we incur that, becomes part of work in process. Overhead, as we apply it, work in process, right? Everything becomes associated with work in process until we finish it, right? So as we incur labor costs, material costs, as we apply overhead using our formulas, it all runs through work in process at some point.
There would be a decrease in factory.
Yes. Yeah, your journal entry there would be a debit to work in process and a credit to overhead. Yeah. Yeah. Number 4. In a job cost system, the issue of indirect materials. All right, so I'm thinking, all right, that's overhead again. The issue of indirect materials to a production department increases what? All right, kind of the same question. Well, it's not though. So this is us incurring a cost, right? We haven't associated it with the goods yet. We are using stuff we're spraying on machines or little staples or whatever. We're using them. Just because we're using them doesn't mean we've associated with a job yet. We do that later, right? So we're incurring an overhead cost here. So in a traditional job cost system, issuing indirect materials into the department means that we're incurring overhead. So our overhead will increase. We're accumulating cost into that overhead account. Y'all remember all of this? If you don't, look back at a principles book. It's too much and too broad for us to really spend the time on it in here. So be sure to look at that.
So what's that factory overhead plot? Is it just like once you put it in work in process?
So B and D are saying the same thing.
Okay.
Yep. And I don't even know what stores control is. That's not a thing, I don't think. I've never heard of it. So, yeah. So, okay. So we'll move on past the principal stuff a little bit and get into some other things.